All right, so you've got the basics of saving and investing down, but now it's time to dig deeper into the tools and strategies that make your money work for you. This is where the real magic happens. First things first, savings and investing are not the same. Think of savings as your safety net. It's there for emergencies and short-term needs. Investing, on the other hand, is your growth engine. It's about building wealth over the long term. Both are crucial, but they serve very different purposes. Let's start with savings. Your savings should be liquid and easily accessible. This means putting it into places like savings accounts, money market accounts, or certificates of deposit, CDs. These options won't make you rich, but they're low risk, and that's the point. They're there to give you peace of mind. Experts recommend having 3 to 6 months' worth of living expenses saved for emergencies. Now, once your emergency fund is in place, it's time to move on to investing. And this is where it gets exciting. Investing is how you make your money work for you. Instead of just sitting in a bank earning minimal interest, your money can grow through stocks, bonds, mutual funds, ETFs, and other investment vehicles. But let's be real, investing can feel overwhelming at first. Stocks, bonds, dividends, ETFs, it's a lot to take in, so let's break it down. Stocks are shares of ownership in a company. When the company does well, your stock's value increases, and you might even get paid dividends. Bonds, on the other hand, are like loans you give to a company or government. They pay you back with interest over time. Stocks are riskier but offer higher returns, while bonds are steadier but with lower returns. If picking individual stocks and bonds feels intimidating, mutual funds and ETFs, exchange-traded funds, are great options. These are collections of stocks or bonds bundled together, giving you instant diversification. Instead of putting all your eggs in one basket, you're spreading out the risk. Think of them as the set it and forget it option. Speaking of diversification, let's talk about why it's so important. You've probably heard the phrase, "Don't put all your eggs in one basket." Well, it applies perfectly to investing. By spreading your money across different types of investments, stocks, bonds, real estate, etc., you reduce the risk of losing everything if one area performs poorly. Diversification is your safety net in the world of investing. Now let's address the elephant in the room, risk. All investments come with some level of risk, but here's the thing, you can manage it. The key is understanding your risk tolerance. Are you someone who can handle the ups and downs of the stock market? Or do you prefer slow and steady growth? Your age, financial goals, and personality all play a role in determining your risk tolerance. For example, if you're in your 20s or 30s, you can afford to take more risks because you have time to recover from any losses. This means investing more in stocks or high-growth mutual funds. But if you're closer to retirement, you'll want to prioritize preserving your wealth, which means leaning more toward bonds and other low-risk investments. Let's talk about one of the most powerful investment strategies, dollar cost averaging. This simply means investing a fixed amount of money at regular intervals, regardless of market conditions. By doing this, you buy more shares when prices are low and fewer shares when prices are high. Over time, this averages out the cost of your investments and reduces the impact of market volatility. Another critical strategy is understanding tax-advantaged accounts. If your employer offers a 401k or similar retirement plan, take advantage of it, especially if they match contributions. That's free money. You can also look into IRAs, individual retirement accounts, which offer tax benefits. The more you can save on taxes, the more money stays in your pocket to grow. Let's not forget about real estate as an investment option. Owning property can be a great way to build wealth, whether it's through rental income or property appreciation. But real estate isn't for everyone. It requires significant upfront costs and ongoing maintenance, so make sure it aligns with your financial goals and risk tolerance. Here's a quick tip. Automation is your best friend. Set up automatic contributions to your savings and investment accounts. When money moves automatically, you're less likely to skip a payment or spend it elsewhere. It's a simple way to stay consistent and make progress without even thinking about it. Now let's talk about fees. Fees might seem small, but over time, they can eat into your returns significantly. Whether it's management fees for mutual funds or transaction fees for trades, make sure you know what you're paying. Look for low-cost options like index funds or ETFs, which have lower fees compared to actively managed funds. Speaking of index funds, let's highlight why they're so popular. Index funds track the performance of a market index, like the S&P 500. They're low cost, low maintenance, and have historically outperformed most actively managed funds. If you're looking for a simple, effective way to invest, index funds are a fantastic option. Let me share a quick story. There's a guy named Mark who decided to start investing in his late 20s. He started small, contributing $200 a month to an index fund. He didn't try to time the market or chase the latest stock trends. Fast forward 20 years, and Mark's investments have grown to over $150,000 thanks to compound interest and consistency. Mark's secret? Patience and discipline. Another tool worth mentioning is robo-advisors. These are automated platforms that create and manage a diversified portfolio for you based on your financial goals and risk tolerance. They're perfect for beginners who want a hands-off approach to investing. Plus, they're usually more affordable than hiring a traditional financial advisor. Let's not forget about the importance of emergency funds, even as you focus on investing. Before you start putting money into the market, make sure you have enough saved to cover unexpected expenses. This way, you won't have to dip into your investments when life throws you a curveball. One more thing. Keep an eye on inflation. Inflation reduces the purchasing power of your money over time, which is why it's so important to invest. By putting your money into assets that grow faster than inflation, like stocks or real estate, you're protecting your wealth for the future. Let's talk about behavioral finance for a moment. Many people think investing is just about numbers, but emotions play a huge role. Fear and greed are two of the biggest drivers of market behavior. Fear makes you want to sell when the market dips, and greed tempts you to buy into hype. The key is staying disciplined and sticking to your strategy. Consider this. Investing is a long-term game. The market will have ups and downs, but historically, it has trended upward over time. Take the example of the 2008 financial crisis. Many investors panicked and sold their stocks at a loss. But those who stayed invested and continued to buy during the downturn saw massive gains as the market recovered. Here's another important concept: rebalancing. Over time, some of your investments will perform better than others, which can throw your portfolio out of alignment with your goals. For example, if your stocks outperform your bonds, you might end up with a riskier portfolio than you intended. Rebalancing means selling some of the overperforming assets and buying more of the underperforming ones to maintain your target allocation. Let's also touch on alternative investments. While stocks and bonds are the bread and butter of investing, there are other options like commodities, cryptocurrencies, and peer-to-peer lending. These come with higher risks and aren't for everyone, but they can add diversification to your portfolio if used wisely. And finally, don't underestimate the power of knowledge. The more you learn about investing, the more confident you'll feel about making decisions. Read books, follow financial news, and consider taking online courses. Knowledge truly is power when it comes to managing your wealth. All right, let's recap. Savings are your safety net, and investing is your growth engine. Diversification, dollar-cost averaging, and understanding tax advantages are key strategies to maximize your returns and minimize risk. Stay disciplined, keep learning, and remember that investing is a marathon, not a sprint. So what's your next step? Maybe it's opening an investment account, setting up an automatic transfer, or rebalancing your portfolio. Whatever it is, take action today. Because the sooner you start, the closer you'll be to achieving financial freedom. And don't forget the importance of mentorship. If you know someone who's successfully built wealth, ask them questions about their journey. Learning from others can provide valuable insights and help you avoid common mistakes. Surrounding yourself with financially savvy people can inspire and motivate you to stay on track. Lastly, set clear financial goals. Whether it's retiring early, buying your dream home, or funding your child's education, having a clear vision of what you're working toward will keep you focused and driven. Write your goals down, review them regularly, and celebrate your progress along the way.